Hello guys, welcome back. So now we are going to discuss about financial management mock test series March 2024 series. So in this first now we are going to deal with question number 1 part A. So without any delay, let's go further. So the following figures have been extracted from the annual report of C Limited. Okay, so they have given some information. Let's see. Net profit of 54 lakh they have given. Okay, so outstanding 12% preference shares. This 12% represents obviously dividend, preference dividend, right? So preference shares of 200 lakh. So of 12% you are going to get 24 lakh. So that is the preference dividend. Okay. The number of shares 2 lakhs. Return on investments, which means R, right? Return on investment, which is 22%, and cost of capital they have given 15%. So no need to see the required guys. With the information given only you can tell what he's going to ask. You have R, you have K. Okay, that means KE. And so you'll get to know what they're asking if you know formulas well. So formulas is really important guys. So you have to by heart the formulas and all. So you'll get more clarity, and you'll be really performed well in the exams. So what they're asking is that compute the approximate dividend payout ratio so as to keep the share price at 120, 120, which is P, which is price. So 120 market price they have given by using Walther's model. In Walther's model only, this R, KE, all these are there. So without looking into the required or anything model or that, you can know the formula by using the given information only. You got to know the formula. Okay, so Walther's model he's asking. So the formula of Walther's model. So and they're also telling that decimal may be taken up to 2 units. So whenever you see this in final exams, especially if you see this, you only if you have any decimal points are there, you only take up to 2 units. If they say you take up to 3 units or something, you take only up to that, because they match with the key answers that they have. Okay, so that is more approximate, right? So whenever this is there in the final exams, you please follow that. Okay, now let's go into the answer. So what they're asking, approximate dividend payout, right? So using Walther's model. So try to remember the Walther's model formula guys. So this is the formula. Please remember the formulas guys. Please read it thoroughly, so that you'll be it's really better for you. You'll do the best in your exams. Formulas has really key role. So what is the Walther's model? Price, which P is, which is market price. So P equals to D plus R by KE into E minus D by KE, right? So they have given what is P and all, what is E, what is KE and all they have given. So P is market price per share, and earnings per share, which is E. E is earnings per share. In the question they have given, which is 15 rupees. Where they have given, okay, we got to calculate this. Okay, and D is dividend per share, and R return on investment they have given 22%, right? So what is KE guys? Cost of equity capital, which is 15%. Now, so here let's come back to this. So they have given net profit of 54 lakhs. So from here you are going to calculate the earnings per share. You have to find out the D, no? So we have P, we have R and KE. We have to find out the D. So we have to know E, no? So earnings. So for earnings, what you'll do, earnings available to equity shareholders divided by number of shares, you get EPS, right? So you know the formulas. So I assume you know the formulas. So I'll just explain you a little bit, but I don't go deep far, because I assume that you know the formulas, right? So net profit after you pay to the preference dividend, what is the equity or earnings available to the shareholders. If you divide with the number of shares, you get earnings per share, right? So net profit is 54 lakhs, right? Now where is this? Yes. So net profit 54 lakhs, and less preference dividends. What is preference dividend guys? They have given the number of preference share capital is 200 lakhs. Upon 200 lakhs, you got to apply this 12%, which is 24 lakhs of preference dividend. So if you subtract this 24 lakh with from net profit, you get 30 lakhs as earnings available for equity shareholders, right? So 30 lakhs is the equity available to the equity shareholders. Now how many number of shares are there? 2 lakh shares they have given here. Number of shares they have given 2 lakhs, see here. So if you divide this 30 lakhs with 2 lakhs, you get this 15 rupees as earnings per share, right? So earnings per share is 15 rupees. Now if you insert all the information given in this formula, you get the D, right? So see, price they have given 120. Yes, price they have given 120, and D you have to find out. And what is R, guys? 22%. Don't take 22% because it's so confusing. So just please convert it into decimals so that you can better, for calculating purpose it is very easy. So 0.22 and 15%, which is 0.15, and E minus D, which is E means earnings, right? So just now we have calculated 15 per rupees. So 15 per share. So 15 minus D, which is D only, we have to find out, divided by 0.15, which is KE again. Okay, so in the formula here, denominator, where, yeah, here KE means 15%, no? So that's why here 0.15 we get. So 120, if we multiply this 0.15 with 120, you get 18. Again, don't confuse yourself here, just look carefully. 0.15 into 120, we get 18 rupees, 18. So again in the numerator, if you observe, there is 0.15 after the plus, right? 0.22 divided by 0.15, he has taken the LCM. So LCM 0.15, and again 0.15 into D, 0.15 D, and 0.22 into 15, which gets 3.3, and 0.22 into D, so minus 0.22 D, right? Now again he has taken this 18 into 0.15, which is 2.7. He has transferred this, 0.15 into 18, 2.7 you get. He transferred this to RHS. So 3.3 here is there, no? Here 3.3 stays here, and this 2.7 is there, no? If you multiply 18 into 0.15, it goes to RHS. So 3.3 minus 2.7, and where this goes? So 0.15D minus 0.22D, which gets minus 0.07 07D, which goes to the LHS side. So this is that 0.07D, which is shifted from RHS to LHS, and this 18 into 0.5 shifted there. So 3.3 minus 2.7, we get 8.57. Sorry, 3.3 minus 2.7, we get something, and if you divide that something with 0.07, you get the total D as 8.57, right? So this is the dividend. Did he ask about dividend, guys? Tell me one thing. Compute the approximate dividend payout ratio. What is the payout ratio he wants? So how do we calculate dividend payout ratio, guys? From the earnings only, you pay the dividend. We have also seen this in law. So from the earnings available, you got to pay the dividend, right? So from the earnings, what is the dividend payout ratio means? From the earnings, how much percentage you are going to pay. So if you remember the statement, from the earnings only, you have to pay the dividend. So what is the dividend payout ratio means? From the earnings, how much percentage you are going to pay. What is the dividend, how much percentage you are going to pay. So if you remember this statement, you'll not by heart the formula, you'll get to know the formula very easily. So DPS by EPS into 100, which is dividend by earnings into 100. 8.57 is the dividend, 15 are the earnings, earning per share, so into 100, so 57.13. So 57, approximately 58% or 57%, whatever it is. So approximately this 57% you are going to pay from the earnings. So 57% of dividend payout ratio, you are going to pay the dividend. Yeah. So the required dividend payout ratio is 57.13, right? Over. Next, B bit. Now capital structure in market value terms of AN Limited is given below. So company AN Limited, debt 50% and equity 50%. So whatever is the value of the AN Limited, the equity and debt are the half of same. Okay. So the borrowing rate for the company is 10% in a no tax world, which is there is no tax, it seems, and capital markets are assumed to be perfect. So borrowing rate they have given 10%, which means debt interest on debt is 10%. Now what is required, guys? If so first bit we'll see, Mr. R owns 8% of the company equity shares. Okay, in company he has 8% a share. So determine his return if the company has net operating. What is net operating income, guys? They have given net operating income as 10 lakhs. What is net operating income? Which is nothing but EBIT, earnings before interest and tax. Here there is no tax, no, so earnings before interest. So this earnings before interest is 10 lakhs, and overall capitalization rate, which is overall, which means not overall means this KO, KE is equity and KD is debt, and overall E plus D, which is companies overall capitalization rate is KO, which is 20% they have given. So with this KO and net operating income, do you remember anything, the formulas and all? So you got to get this. What is that? Total value of the firm, guys. Total value of the firm. See here, value of the firm, which is AN Limited. Value of the firm formula, NOI by KO. NOI means earnings before interest and tax. So in the formula itself there is this earnings before interest by KO. We get the value of the whole firm. So NOI is 10 lakh they have given, divided by 20%. So whole value of the firm is 50 lakhs. So in the starting itself they have given no equity 50% and debt 50%. So if the total value of the firm is 50%, then what is debt and what is equity? 50-50, no? So 25 lakh, right? So value of the company 50 lakh, and market value of the debt is 50% of 50 lakh, which is 25 lakh, and market value of shares same, 50 lakh into 50%, which is 25 lakh, right? Now in particulars they have given net operating income as 10 lakh. 10 lakh only now they have given. So 10 lakh, right? So here they have given the borrowing they have given the borrowing rate as 10%, which is 10% interest on the debt you have taken, right? So from EBIT means there is no tax, obviously. Earnings before interest, this net operating income is nothing but earnings before interest. So if you deduct the interest, what we get? Earnings after tax, earnings after interest and tax. There is no tax, so in earnings, just earnings available to equity shareholders, because there is no preference here. As there is no preference, all the earnings goes to equity shareholders only. So net operating income is nothing but earnings before interest. I told you, no? So 10 lakhs, and after deducting interest you get this earnings available to shareholders. But what is the interest, ma'am? 25 lakh is debt is there, no? Into 10% we get this 2,50,000 as interest. So 10 lakh minus 2,50,000, which is earnings available to equity shareholders, which is 7,50,000. Now what is he asking? R owns 80% of equity shares, it seems. So what is his return he is asking simply. So if he holds 8% of shares, what is the earnings available to shareholders, guys? Simply, earnings available to shareholders is nothing but their returns, right? So if 7,50,000 is their return, how much I hold, how much I own? Only 8% of that return. So 8% of 7,50,000 only I have the rights. So 7,50,000 into 8%, which is 60,000, goes to Mr. R, right? That's what he's asking. So he says Mr. R owns 8% of equity shares. So that only we have calculated 8% of 8% of 7,50,000. So 60,000 R gets, right? Now second bit, what is he asking? So calculate the implied required rate of return on equity. So implied required rate of return. Now here he says 8%. Sorry, where is this? So yeah, 8% of equity share means how much he gets. He's asking just before this in bit number 1. So now he is asking what is the percentage. Okay, so what is the implied required rate of return on equity? Not for R, he's asking, not for R. Just delete R from your mind. Okay, so now he is asking rate of return on equity. So this all the earnings are belongs to equity only, no? So earnings available to shareholders means all goes to equity shareholders only. So 7,50,000 goes to equity shareholders. And how much is the total equity, on how much amount of investment this 7,50,000 goes to? 7,50,000 goes to equity shareholders only. Upon how much investment? 25 lakhs, no. 25 lakh for debt and 25 lakh for equity. So 25 lakh is the investment only, no. So from the investment 25 lakh, they get 7,50,000 as the return. The 7,50,000 is the return only, no. So what is the implied required rate of return means 7,50,000, which is earnings, which is return, which is nothing but return only, and divided by 25 lakhs, because this is the equity. 50% of 50 lakhs we have done, no. So 25 lakhs. So 7,50,000 divided by 25 lakhs, which is nothing but 30%. This is called implied rate of return, guys. Okay. So this is also done. Now let's see. Anvi Limited has furnished the following ratios and information for the year ended March 31st March 2023. They have given equity share capital 2 lakhs, and the relevant ratios are given: current debt to total debt to equity share, and all they have given some ratios, and you are required to prepare balance sheet of NV Limited as on 31st March 2023. They have given. See, I'm just giving you a small tip. The people, those who know, okay. The people who don't know, I'm telling you. So whenever you see this ratio analysis, they will give you some numerical one or two. They give, for example, in this question, they have given equity share capital as 2 lakh. This is numerical value only, no. They don't give all the ratios and tell you to calculate. They'll give one or two information with numericals, and all the remaining they'll give you ratios. So whatever the numericals they have given, like here for example in this question they have given equity share capital in the numerical value. Okay. So while solving the answer, like don't take the whatever the first ratio they have given, don't try to solve it, because current debt to total debt, we don't know either of them. Current debt you know, total debt you know, you don't know both. So don't take the first ratio as to solve. Okay, don't take that first one, take the second or third, because in those two there is equity share capital and we have the numerical value of that. No, you understood now? So take the second or third ratio. You better take the second one, because if you solve this second one, you will get total debt, and if you put this total debt in the first ratio, you will get the current debt. Okay, so better to take this second one. So total debt to equity share capital, which is 60, 0.60, and you are going to get the total debt, and you are going to substitute this total debt in the first one, which is 0.5 they have given, no. Now you'll get the current debt. Likewise you have to do it. First of all, just make a rough balance sheet in the rough paper, then you can do with the ratios. You'll do, no, after getting the answers and all, you put that figures in the balance sheet. Now you get it. Okay, so equity share capital as 2 lakhs. Now there is total debt and current debt something. So this total debt means current debt and the other debt, no, which is long term debt. So current debt and other debt, total debt is there. Okay, you put this as totals. You have fixed, obviously in assets are fixed assets, current assets, and other non-current assets are something is there, no. So yeah, so fixed assets and current assets in asset side, right? So if they have given inventory, fixed assets, inventory, and other current assets, right? Okay, now here we have equity share capital as 2 lakhs. Now see, he does this the same. Total debt he has taken, where is this? Yes, here. Total debt to equity share capital 0.6. He has taken the second ratio. Why? Because equity share capital we have the numerical value. So only that you have to take it. So total debt equals to 0.6 of equity share capital. So total debt comes to 1,20,000. And further, current debt to total debt they have given, no, 0.5. So current debt is equals to 0.5 of 1,20,000, which is 60,000. So see here, so total debt we got 1,20,000, no. If you substitute here, current debt you will get 60,000 and other debt you will get 60,000, because it is 0.5, which is 50%, no. So 1,20,000 we got. So current debt 60 and long term debt 60, because 0.5 they have given, no, 50-50. Current debt 50, which is 50%, that is 60,000, and long term debt 60,000, right? So 2 lakh plus 1,20,000, which comes to 3,20,000. Here also 3 lakh 20. Why? Because liabilities equals to assets, no? So what is total assets, guys? 3 lakh 20. Now, in the third ratio, they have given fixed assets to equity share as 0.7. No, we have equity share capital. So now we can find fixed assets or not? Yes. So what is fixed assets? 0.7 of equity share capital. Now we got to know this fixed assets. We know no total assets. We just know calculated. Where is this? Okay. We know what is total liabilities. So total assets also same value. Balance sheet tallies or not? Balance sheet tallies, right? So here also 3 lakh 20, here also 3 lakh 20. Now fixed assets, we have this 1 lakh 40, right? 1 lakh 40. Now other, this if we don't have inventory in the question, directly you can take the current assets as 1 lakh 80. But they have inventory separately in the question they have given. See. Total assets they have given 2.5 and inventory they have given 10 times. If they don't have any inventory or something, they don't have any inventory ratios and all, you can directly take as current assets, but they have inventory, so you have to calculate it. So how do you calculate? See here. So total assets to turnover is 2.5 and inventory turnover is 10 times. Tell me, using these two, can we write inventory by total assets as 2.5 by 10? 2.5 by 10. How, ma'am? Total assets to turnover, which means total assets by turnover equals to 2.5. And this inventory turnover means turnover by inventory is 10 times. Which means you reverse it. Inventory by turnover is 1 by 10, right? So inventory gets cancelled. And now inventory by total assets equals to 2.5 by 10. So if you match this two, you put it together and see, you'll get inventory by total assets as 2.5 by 10. Now we have total assets or not, tell me. I already told you, no, total assets equals to total assets equals to total liabilities. Balance sheet tally hai. No. So total assets equals to 3 lakh 20. We know this to total assets. So what is inventory now? 2.5 by 10, no, 2.5 by 10, which is nothing but 1 by 4. Now we have total assets. So 3 lakh 20 by 4. So we got the inventory as 80,000. We already discussed, where is this? Yeah, we already discussed that apart from fixed assets, what are there? Current assets only. Current assets total, in total, which is 1 lakh 80. But we have the inventory as 80,000. Now you can directly, make it as other current assets as 1 lakh, or you can also write cash, because apart from cash and inventory, what else is there? Debtors also there, no? So we can't say it is definitely cash, but yeah, you can write other current assets, or you can write whatever. Right now tallied, no? Yes. Oh my god, tallied. Yes. Okay, so now that you have prepared the balance sheet, so required, done. So yeah guys, that's all with the first question. Let me know in the comment section, and if you want any other videos, any other subjects, or any other mock tests or something, so please do subscribe to the channel guys. Thank you for watching.